We are in a phase where markets are being shaped by a mix of global uncertainty, elevated commodity prices, and shifting interest rate expectations.
In this conflict, Strait of Hormuz, that has come into limelight because I think it carries between 20 to 25% of maritime oil from that passage. Our projected inflation right now at 3.4%, but honestly, going by what is trending up in terms of oil prices, I think you will see an upward revision in the inflation going ahead. So you will see going ahead, there will be renewables, there will be solar that will come into focus. Government will kind of, under various schemes push solar and other renewables as an alternative. You will always have diversified allocation across asset classes. I think precious metals has gone through a change. You can say it's a paradigm shift that has happened in the last couple of years. I don't see gold coming down the way it would in the recent time. I think it went to 2 lakhs and then came down. It would fundamentally stay at this level and probably compound at single digits, maybe 8-9%. Come and kind of look at that kind of returns. But I would definitely allocate 10 to 15% on the overall portfolio into
We are in a phase where markets are being shaped by a mix of global uncertainty, elevated commodity prices, and shifting interest rate expectations. And yet, despite these moving parts, investor participation, especially from high net worth individuals, continue to remain strong. But what's clearly changing is how investors are approaching markets today. It's no longer just about chasing returns. It's about balancing growth with preservation, being selective with allocation, and building portfolios that can navigate different market cycles. From equities and fixed incomes to alternatives and global diversification, the choices today are far more nuanced, and so are the risks. So, how should HNIs and ultra HNI investors think about their portfolios in this environment? Where are the real opportunities? And just as importantly, what are the risks that may not be immediately visible? To help us break this down, I am joined by Mr. Vivek Choksey, Zonal Head Wealth Management at MK. He brings nearly 2 decades of experience in wealth management and leadership roles across top institutions, across banks and AMCs, with a deep passion for markets and investing, especially from an HNI perspective. Welcome, Vivek. It's great to have you with us. Thank you for taking the time out for this.
My pleasure, Kirti. Always good to talk to you.
Yeah. So, Vivek, if you step back and look at the markets today with global uncertainty, elevated crude prices, and bouts of volatility, how are you perceiving markets right now? Both India, globally, both. And where do you think the pendulum lies between macro shocks and micro resilience?
So see, current markets are driven by geopolitical conflicts, and that in itself, I think, is the dynamic nature of the markets. If you see the recent movements in the markets, and as recent as maybe 10 days back, you see the market trend, on one announcement of ceasefire, it just went up, and it just kind of 22,000 touched 24,000 Nifty. But when the ceasefire started fading off, you see the markets kind of retracing back. So that in itself brings a perspective that how sensitive the markets and the world economies are to oil and energy as a sector, or fossil fuels as we call. That in itself, if you see, since the conflict started, the oil from $70 is now hovering around $100, $105, $106, right? Now that is a quite big pricing shock for economies like India and the most important economies, wherein they import most of their oil, most of their gas requirements. Like in this conflict, Strait of Hormuz, that has come into limelight because I think it carries between 20 to 25% of maritime oil from that passage, and that is a passage to all the oil imports to Asia. So that in itself becomes a very crucial point. So going ahead, there is supply shock that is there. Pricing on oil will also have its bearing on inflation. Our projected inflation right now at 3.4%. But honestly, going by what is trending up in terms of oil prices, I think you will see an upward revision in the inflation going ahead, and thereby there could be some margin pressures coming in the next 1 or 2 quarters.
Understood. So yeah, we have seen such phases, where market kind of also remains resilient despite global shocks and risks. And this time does feel different. And I was actually wanting to ask you that, when it comes to India, how is it taking these global shocks? What is the implication that you see on Indian markets from oil and gas and all the supply chain disruption that has happened around the world now?
See, what has happened is, the dependency on energy and oil and gas has gone up, right? And with the supply shocks, we are now back to square one, wherein we are saying that still the economies are dependent on that. So now, alternatively, I think recent announcement even in the government of India made, I think they are looking at, so there has been a highest demand of power in the country due to summers. I think summers have caught up early, and that in itself there is a surge in demand. So you will see going ahead there will be renewables, there will be solar that will come into focus. Government will kind of, under various schemes push solar and other renewables as an alternative. Having said that, power in itself is a critical component, right? So that in itself, if you go to see, that will be addressed over a period of time. But in terms of your situation, in terms of current situation, there could be a scenario that Indian economy per se, there could be probably a slowdown. Or maybe I would say that there could be the next 2 quarters will have a flattish kind of projection in terms of growth. But overall, I feel that in the longer term, I think we are pretty well placed. If you see from a logistics perspective, I think between 60% of gas is kind of imported from the Middle East and Qatar specifically, and oil also around, I think 30 to 40% is imported from that belt. Oil, however, has an alternative. Say Russia, Venezuela, I think things are kind of very dynamic over there. But gas in itself, I don't think so it has an alternative. And that's why if you see our government was more, I would say, up the guard in terms of gas and in terms of LPG requirements. So I think that supply is getting sorted fast. Crude oil also will get sorted. But honestly, these will have some kind of short-term repercussions on the economy.
Got it. And when I actually now come down to Indian equities, FIIs have been selling almost continuously since September 2024. They have offloaded almost $45 billion of assets and from the Indian markets during this period. And it's not just FIIs, even promoters have offloaded significant stake during the market run-up. And there has been a modification in the ownership structure that has been undertaken because of this. So how would you read these shifts? What's happening to this ownership mix between promoters, DIIs and FIIs? And, how should investors really read these cycles and read these sell-offs and the sustained selling and the stake reductions? How should investors go about it?
See, when it comes to the markets and the liquidity, I feel liquidity is very important. More than fundamental, it's the liquidity that drives the markets. And if you see, our markets were driven by domestic liquidity. I think that has stood the test of time. Our SIP figures, though the velocity might have just reduced, but on month basis, now we have reached 32,000 crores. So that in itself is a huge figure, in terms of deployment into the markets. And that in itself kind of acts as a shock absorber, wherein in FIIs, wherein other avenues like promoter stake sale, FIIs have been looking at selling. Now coming back to FIIs, I think currency plays a major factor. We have, I think our currency has depreciated the highest vis-a-vis a dollar in the recent 2 quarters. And that in itself has, from an investor angle, FIIs have kind of looked at other alternatives on the emerging markets. So if you see data, I think Taiwan, South Korea, in the emerging markets have attracted a lot of FIIs, Vietnam as well. In the developed market, obviously China also stands as when it comes to large cap, we are probably at a PE of 20, and given our GDP forecast of 6.9% and inflation at 3.4%, we are decently valued. I would not say maybe we are at the median. We are not at the higher end, we are not at the lower end. So ultimately I feel that when it comes to FIIs, they will look at allocations once the economic situation in terms of earnings kind of stabilizes and shows an uptick, and all the inflation and all the GDP kind of stabilizes and the currency stabilizes. That is when I feel that the FIIs will come back. This phenomenon happened in late 23 to 24 when FIIs had come, and the scenario was very similar. This time also, I think in the similar scenario, they should come back in a couple of quarters.
Fair enough. And you spoke briefly about valuations, however, and that is prominently the reason why FIIs even took an exit from India. But I also wanted to understand your point of view when it comes to valuations across segments, across market cap classifications. Are we still pricing in a lot of optimism, or where do you see pockets of excess, and where do you still see reasonable valuation?
So see, I honestly believe in markets, and we as investors, we should know that seldom good price and good situations come together. It's always from an investment perspective, it will always be bad situation and good price. And that is, I would say, a soft spot to invest into. You will never have an Indian market which is growing at, for example, GDP of 8%, inflation at 2% and PE at 16. That's not happening. Only thing the investors have to look in a bad situation is that, are micro parameters in place? Is our economy shielded through domestic consumption? Is our economy shielded through valuations? So that is where you have to take the call. So honestly, when it comes to valuation, you see in the recent fall, I think large cap, if you categorize equity into market caps, large cap PE had reached around 19, and right now it's hovering around 20. But the interesting trend is in mid cap and small cap. So if you see mid cap, I think the PE had reached around 24, and right now it's like hovering around 30. Similar trend in small cap as well. It reached around 23 and now 28, something of that sort. So, this is the situation when there is a lot of chaos in the market, when there is a lot of selling in the market. Fortunately, unfortunately, the valuations settle down. And that is a very lucrative or a very exciting point to invest into. But more often than not, as an investor, we are driven more by our emotions, sentiments than fundamentals. We, however, always say that we should look at valuations, we look at fundamentals when the markets are up. But you will invariably see that and including us, all investors, it's a psyche of investors, that at 23p, 24p, when the economy is probably showing growth of 7.9 towards 8%, we will invest because that looks comfortable. So it is a very dichotomy kind of a situation. But yeah, when you invest, when the valuations are reasonable, is when you will kind of monetize or grow your portfolio in good times.
So while we discuss multiple perspectives, I actually got an interesting take from none other than our market legend, Peter Lynch.
People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
It's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
So I just also wanted to check that, what do you think of this?
So, see, this is very relevant when you are kind of analyzing a company to invest into. When you are looking at a company from a business standpoint, from a standpoint of the promoter and the forecast and how it's kind of going to do, and what is the kind of alignment with the economy, what are the business and stuff like that. But when it comes to allocation overall, you will have to look at multiple parameters. You cannot have one company in your portfolio, right? However good it is, you will always have diversified allocation across asset classes, be it equity, be it debt, be it precious metals. be it global markets. So, all that factors have to have to be taken into consideration when you are kind of deriving a portfolio. So, I would say this is relevant, very relevant to stock picking. But on the overall wealth side, you will have to look at multiple parameters.
Yeah. And talking about asset allocation, considering the markets being dragged down by war disruption, what new avenues of asset classes do you think come into play for investors who can, explore beyond equities? How would you play debt, especially with the recent spike in the yield curve from 6.5 to 7 levels? And after a very strong run over the last year, what's the emerging narrative around metals?
So I would answer this in two parts. First is actually in three parts. First is the debt part. So I would like to reiterate over here. So our internal head of research, Dr. Joseph, we had given a buy call on GSEC, on 10-year GSEC, when it was hovering around 7.2 odd. And then from then on, we had a unprecedented run of around 6.4, then to 6.2. That is when he had initiated a sell call as well. And post that, we are now hovering at 6.8, 6.9. I think it's reached 6.96 odd. So going ahead on debt, you could still play on accruals. The curve, the yield curve is upward moving, so the short-term rates are lesser than the long-term rates. So, however, what we are looking at is still you play for accruals. 80% should be accruals. Maybe within the 80% you could have 3 to 5 year durations, which could be a midpoint in terms of allocation into debt. You should probably go for good quality papers, maybe AAA, AA types. And if at all you can kind of have a particular basket of investments that you can look at, maybe a lower category paper as well, then this would be the right time for 3 to 5 years to look at that kind of company, could give you double-digit returns. But this is how I would play debt. Once probably 20% would be in duration, which could increase once it goes up further. But for now, I would place 80% into accruals. Second part is precious metals. I think precious metals has gone through a change. You can say it's a paradigm shift that has happened in the last couple of years, because gold was always looked at hedge against equities, and to some extent related to dollar as well. But now on, what has happened is, due to a lot of de-dollarization, there is some percentage of gold, and there is significant, I would not say obviously it's not reached dollar reserve, but significant amount of gold that central banks are buying, be it China, be it India, all central banks, because there is no alternative to USD. So I think gold in itself will have its inherent demand. I don't see gold coming down the way it would in the recent time. I think it went to 2 lakhs and then came down. It would fundamentally stay at this level and probably compound at single digits, maybe 8-9%. Come and kind of look at that kind of returns. And coming to silver, I think silver in itself has seen a lot of speculation and volatility. At around 1,25,000 rupees. That in itself was a very good level, because the gold silver ratio, as we say, I think was skewed towards more of gold, and that's why silver had to do a movement, and that's historic. So now I think silver will have its own inherent demand, be it all your electronics and other uses, solar panels and a lot of usage. So that will also be there. So I honestly feel that silver will also attract some funds. Both to put together would be in probably early teens in terms of CAGR, probably 9 to 10% is CAGR that is expected. But I would definitely allocate 10 to 15% on the overall portfolio into precious metals.
That's fair. And one last question before we go. As we eye the markets, as we look at FY27, what would be your overall view on an investment portfolio? How should an investor think about asset allocation? I know you have given your exposures to metals and to debt. However, in overall, if I want to, consider the allocation, that is one. And also within equity, do you also consider some basket of emerging and developed in your portfolio? And also between market cap, how do you play across market cap classifications would be very helpful.
So as an exercise, Kirti, portfolio allocation is very individualistic. It depends on each investor, what stage it is in, what kind of risk appetite, what kind of horizon. If at all we take a classic example of a longer term horizon with capital appreciation and capital growing as a motive and objective, my broader allocation would be around maybe towards 60-65% in equity. I would say 10-15% would be in debt, and 20% would be in precious metals. Within equity, we would have large cap as the larger portion, because I think they always stand the test of time. These companies are large companies, so even if they have kind of beaten down, they come up well and then they attract more investors. But now when it comes to valuations, sometimes, and in the recent trend, you've seen that mid cap and small cap were very lucratively valued. And I saw a lot of SIPs, domestic SIPs going into mid cap and small cap. So it depends, very individualistic. I would, look at it in a very broader manner. Is equity should be your larger portion, and debt and precious metals. That's how it should be. Obviously, there is another avenue of unlisted as well, but that would come in the high risk, high return category. And this is basically, I could give this is an allocation for a medium risk kind of an investor. But coming back to the markets, I would say that, when fresh funds come in, you should stagger it, but you must participate. We should look at least starting with 25 to 30%, and then stagger the remaining 70% in 2 or 3 tranches. That is important.
Got it. And between India versus emerging versus developed economies, how would you?
So see, in emerging markets, I would allocate it through funds, because any individual investor would not have, and as wealth advisor also, we would not have the expertise to give you and pick and choose any particular company. The markets that are looking good are Taiwan, South Korea, which I mentioned. So those markets, you rather take China, you rather take exposure through funds, and they will be more consistent, because they would kind of analyze the company, they would kind of deep dive into the companies. So that would warrant an allocation as well, because I think a lot of liquidity is chasing them. They are fundamentally very sound. So I think that could warrant another 5-10% allocation.
Understood. Fair. Well, thank you. Thank you, Vivek, once again for your time. It is always pleasure catching up with you and, discussing markets. Yeah.
Thanks, Kirti. Always pleasure. Investing is an art, and I always feel that, when an investor should not look at time in the market, it should rather the other way around. It should not look at timing the market, look at time in the market, because in the long term only that prevails.
Yeah.
Yeah.
Great.
Thank you.
Thank you
you so much.
So what clearly stands out in today's environment, investing is no longer just about chasing returns. It's about building resilience. With markets navigating uncertainties, evolving valuations, and multiple asset class opportunities, the focus for HNIs and ultra HNI investors is shifting towards disciplined allocation, risk management, and long-term wealth creation. As you highlighted, the role of diversification across equities, fixed income, and alternatives is becoming increasingly important, along with a more thoughtful approach to capital deployment. Ultimately, success in this environment comes down to clarity of strategy and consistency of execution. Thank you once again for joining us, and thank you to our viewers for tuning in. We will continue to bring you conversations that help you make more informed investment decisions. At MK Wealth, we use our proprietary Enhanced Efficiency Framework, or the ENEF model, to bring a more scientific approach to fund selection. It's a parameterized model developed by our in-house experts with a proven track record of over a decade. What makes ENEF powerful is that it doesn't just look at returns. It combines both return-based and risk-based factors to identify the potential outperformers. The idea is to simply move beyond subjective decision-making and help investors make more objective, data-driven choices while building well-balanced portfolios.